Promise, let's talk about Persistent Systems. They've reported a very strong quarter, a 5.8% dollar revenue growth on a quarter-on-quarter basis, EBITDA margins coming in higher than street expectations, expanding by 30 basis points. We're now joined by Sandeep Kalra, the CEO and ED of the company on the show. Now, Sandeep, thank you very much for joining in. The worry in the street is that your company is facing some client-specific challenges. Can you talk about it? Is that true? And was growth affected this quarter on account of any client-specific challenges?
First of all, thank you for having me here. The growth for the quarter for us overall was pretty healthy at 5.8% in dollar terms. And if you look at the constant currency terms, it was even higher. Now, when it comes to client-specific, issues, there is a portfolio of clients that we deal with. If you look at our greater than 5 million customers, we have 30 customers greater than $5 million, and details are there in the fact sheet. So there will always be puts and takes. There will always be some customers which will grow faster. There may be some projects that finish. There may be some short-term optimizations that might happen. So we are not worried about the growth overall. This is the sixth quarter. If you look at the rupee growth, which is greater than 9% sequential. So from that perspective, absolutely not worried about the growth. And there will always be a portfolio. Sometimes services will grow, IP will grow. Sometimes one client will grow, sometimes the other client will grow. So no worries at all.
All right, no worries at all on that front. By the way, Canara Bank's numbers are flashing on your screen, and take a look at the stock because that is also moving up. So we do have a beat coming in on the profit front. On the NII front, it is looking like quite a good showing. The stock has just spiked up, net profit at around 2,500 crores. This is versus estimates that we had of around 1,950 crores. There's a good beat on that front. The NII has also come in above what was expected. It's at 7,434 crores. So there is a little bit of a beat there as well. This is versus the estimates of 7,300 crores. Provisions have come in at 3,637 crores. So the stock is looking quite good. We are going to get Abhishek in to fill us in with some details. But first, let's get back to the conversation that we're having with the Persistent Systems management. Mr. Kalra, can you take us through what you're expecting by the end of FY23 in terms of revenue and growth? In this quarter, you did hit a quarterly annualized run rate of around $1 billion. So can you take us through the growth expectations?
So for FY23, if you look at it for our last year, we were at $766 million. Our current run rate that we announced is 1022 billion or 1022 million, which is 1.022 billion. That itself is about 33% year-on-year growth rate. You can extrapolate. Even if we were to grow at a moderate pace from here, which may not be the case, we will grow at a fairly healthy clip. The least we will see is about 33% for the year.
Okay, hi Sandeep, morning. What would be the organic growth in FY23?
So a significant chunk of the growth is organic. Even at the current levels, roughly for the year, if you look at it, we are about 30+% on organic terms. And now the rest few quarters, we do not expect any inorganic contribution. So it will be fairly healthy organic growth and among the industry leading growths from an organic perspective.
Strong commentary. They're expecting a 33% revenue growth for the full year, at least. And a chunk of that is going to be organic. Sandeep, can we talk a bit about margins? In the first half of the year, your EBIT margins were 14.5%. It's been steadily expanding. This quarter, you managed to expand margins after absorbing the wage hike impact. Can you build on these margins? What's the outlook for the next 2 quarters?
Right. So look, we have been, having an endeavor to make sure that we move up on the margins as we grow the revenues significantly. Now, for us, if you look at the quarter gone by, we've already done the pay hikes. So we have, absorbed the pay hike. The margins are after the pay hikes. The attrition for us is stabilizing and for the industry as well is stabilizing. So that should also have a moderate to positive impact on the margins. We have inducted a lot of freshers. As they become, billable, as we, increase our utilization, all of those are levers to us in terms of, making sure that the margins are where they are. And hopefully, over a period of next few quarters, we take it up from there. So at the least, we are looking at, the last year margins, which were around 14% at an EBIT level and improving from there for the full year.
All right, improving from the 14% level. Mr. Kalra, the BFSI revenue growth at around 3% is lower than what, the company's average is. What is the reason for this?
So if you look at the growth overall, there are quarters where BFSI growth has led the company growth, and there are quarters where technologies, companies, the ISVs that we deal with have led the quarter. So it's always going to be, some deal wins that happen, that ramp up and so on. overall, yeah, some quarters from now you should see maybe this being the leading segment among the three. We have three segments: the ISVs, the tech companies, and the healthcare life sciences. So pretty much we don't see any reason for this to go down. So this will be depending on deal wins and deals ramping up, and at times there is deals that we win where we are helping optimize the spend, where we take on some on-site work to start with and we transition over to offshore. So those are the puts and takes. So nothing to worry there, and pretty robust pipeline there as well.
Sandeep, FY23 is going to be a solid one for you, right? This quarter annualized dollar revenue has crossed $1 billion. Quarterly rupee revenue is above 2,000, trailing 12-month EPS above 100. But now that you have set the bar so high, what can we expect in FY24, where the concern is a macro slowdown can moderate growth?
Right. So if you look at our order book from a trailing 12-month perspective, the TCV is about $1.457 billion. And from a trailing 12-month perspective, the ACV is $1.087 million. So from that perspective, the overall order book that we have positions us fairly well for continued growth. And obviously, we have two more quarters to do the order book, perform, and so on. So we are relatively, confident. We have to be cautious. The macroeconomic environment is where it is. We don't control that. But with every adversity, we are seeing, good amount of possibilities for companies like us. We are fairly differentiated in the enterprise software market. We are fairly differentiated in the digital market. So that's what is giving us the confidence of having a fairly healthy growth as we go along. I wouldn't want to give forward-looking guidance, but if you look at the order book, fairly confident of continued performance.
Confident of continued performance. How would you assess the demand today versus, say, 6 months ago?
So the demand, if you look at it, the demand shaping has changed. The demand 6 months to a year back was more about revenue acceleration, was more about investing in the digital transformation activities. The demand today is partly that, and partly it is about cost optimization. Because if any of our customers, for example, a bank wants to be more digital in nature, they have to squeeze out money, whether it is from their physical bank branches or technology investments, which are bank business as usual. So we are looking at the pipeline for companies like us being shaped around cost optimization much more than it was 6 months to 1 year back. So that is a new trend, and larger deals are in the offing on those lines, whether it is the independent software vendors we work with, whether it is banking, financial services, or healthcare life sciences kind of companies.